Okay, let's jump right into it. Welcome to our deep dive, where we unpack the crucial details straight from the source.
That's right. Today we're looking at a recent earnings call, one that actually happened on pretty short notice.
Yeah, they felt the need to communicate something significant outside their normal schedule. So our mission here is to break down those updates.
Exactly. We'll cover what they announced, why they said it happened, and maybe what signals that sends about the company's health and direction right now.
And the core reason for this unscheduled call, it was a necessary revision to their 2025 financial guidance. A pretty big deal.
A very big deal. They had to reset expectations. So the new guidance for 2025, they're now expecting organic revenue growth of just 1 to 2%.
1 to 2%. That sounds like quite a step down from whatever they were thinking before.
It is. They didn't state the previous figure on the call, but yes, it's clearly lower. And on the profit side,
What's the margin picture look like now?
they're guiding for an adjusted EPDR margin of around 20%. But here's a key takeaway. Adjusted earnings per share.
The bottom line.
Right, the bottom line per share. They expect that to decline in a low double-digit percentage range compared to last year.
Wow, okay, so lower growth and falling earnings per share. That paints a different picture. Why the sudden change? What reasons did management give?
Well, it's interesting. They explained that the headline numbers for Q1 2025 actually looked quite strong.
Oh, so what's the issue then?
The issue is why they look strong. It was mostly because they included the results from Bormole Pharma for the first time, the company they acquired.
Ah, the acquisition effect.
Exactly. When you strip that out and look at the organic performance, how the core business did compared to last year, both organic sales and earnings actually went down in Q1.
So the underlying business, the legacy operations, they weren't performing as expected.
Precisely. And they got quite specific about the problem areas. First, they mentioned subdued demand in the cosmetic market.
Cosmetics, okay.
Yeah, seems like discretionary spending might be a bit soft there. And it particularly impacted their molded glass business.
Was that the only thing dragging them down?
No, not the only thing. They also pointed to a timing issue with their syringe business. Some revenues expected in Q1 got pushed into Q2.
Okay, so that revenue wasn't lost, just delayed.
Correct. And they did say that revenue was realized in Q2, so that specific point is, let's say, less concerning than an underlying demand issue.
Makes sense. What else?
This one's significant. They saw a major decline in demand for packaging used for oral liquid medications.
Like cough syrups.
Exactly like cough syrups, and this hit both their plastic packaging and their molded glass segments. And crucially, they said they expect this weakness to stick around until the next flu season kicks in later this winter.
That's quite specific. Linking packaging demand to the flu season makes you think about their market exposures.
It really does. And all the softness, especially the unexpected organic dip, has that knock-on effect on profitability we talked about. Lower sales.
Means less revenue to cover fixed costs.
You got it. Things like factory overhead, core salaries, equipment depreciation, those costs don't change much. So when sales dip, margins get squeezed. That's the lower fixed cost absorption they mentioned.
Got it. Okay, so Q1 had these organic declines, some timing stuff leading to the guidance cut. What about Q2? They give some early numbers, right?
They did, some preliminary figures. The positive spin is that they did get back to organic growth in Q2, as they thought they would.
But I sense a but.
But the growth was slower than they'd hoped for. The preliminary Q2 numbers showed low single-digit organic revenue growth.
Low single digit, okay. And margins?
The adjusted EPDR margin for Q2 was around 19% based on those early figures. So yes, growth returned, but it wasn't, the strong rebound needed to keep the original full-year targets in play.
And that weaker first half overall is why they had to pull back the full year forecast?
That's exactly what management said. The combined performance of Q1 and Q2, that slower than expected momentum, just made the old guidance unreachable.
All right, so a challenging first half. What's the outlook now for the second half? Are they expecting a big improvement?
Yes. They are forecasting a significantly stronger second half. They're banking on several factors to drive that pickup.
Okay, what are those drivers? Let's break them down.
Well, first, getting key sites back to full capacity. They mentioned the Morgan site is recovered from flood damage, and importantly, the lower site is fully operational after a big furnace replacement.
A furnace replacement? That sounds like a major piece of work.
It was. They described it as a large furnace. It was down for 6 months. So having that back online is expected to add significant volume in H2.
Makes sense. Just getting production back to normal helps. What else are they counting on?
They're also expecting a boost from new production lines ramping up. These are part of their growth projects finally coming online.
So new capacity contributing.
Right. And they're still very positive on their system solutions for biologics, complex drugs, and that includes the GLP-1s.
Ah, yes, the diabetes and weight loss drugs.
Right.
Huge market.
Huge. And they are clear. Their outlook for GLP-1 related sales hasn't changed for the full year. They expect that alone to contribute about 4% to the entire group's growth.
Wow. Just GLP-1s adding 4% growth to the whole company. That's substantial.
It really highlights how important that segment is. They also think their wider range of high-value solutions will help both the top line and margins in the second half.
Okay, so better product mix helping margins too. And what about the Bormole integration? Is that going smoothly amidst all this?
Management said it's progressing well, on track, and they're realizing the planned synergies. There was an analyst question, though.
Oh, about what?
About whether Bormole might have sort of pushed sales hard just before the acquisition closed, contributing to the oral liquid softness now.
Channel stuffing concerns.
Kind of. Management basically said it's hard to tell for sure, but they stressed the oral liquid weakness hit both Bormole and the legacy business, suggesting it's more of a market trend, though maybe it caused some customers to destock.
Okay, that adds some context. Let's shift to the strategic stuff in the financials. They talked about the molded glass business review.
They did. Confirmed it's still ongoing, results expected in the second half of the year. And they made a point of saying this review is separate from the recent weakness in cosmetics, even though cosmetics uses molded glass.
Right. And then there's that dividend announcement. Quite a shocker.
Absolutely. A really significant move. For the 2024 financial year, they proposed slashing the dividend from 125 cents per share way down to just 4 cents.
4 cents. That's drastic. Why such a deep cut?
The stated reason was clear. To maintain financial flexibility in the current situation, it strongly signals they're prioritizing cash conservation right now.
Definitely sends a message. Given that, how did they describe their overall financial position? Are they worried?
They characterized the capital structure as robust. They also pointed out they extended the bridge financing for the Bormole deal, pushed it out another year to September 2027.
Buying more time on that temporary financing.
Exactly, gives them breathing room. And regarding liquidity and debt covenants.
Yeah, always a concern when guidance drops and leverage goes up.
They tackled it head on. Said liquidity is sufficient. They have about 550 to 600 million euros in unused credit lines. And importantly, they stated they do not expect to breach their bank covenants.
Even with higher debt levels, what was the leverage?
They acknowledged leverage is temporarily elevated, around 4.1 times earnings in Q2. But saying they don't expect a breach implies they still have some headroom within their agreements.
Okay, that's reassuring for them. Any details on the debt itself? Interest rates.
Average interest rate on net debt is around 4 or 5%. And the debt mix is roughly 50% fixed rate, 50% variable. So about half their interest costs could move with market rates.
Got it. And what about cash flow for the year? Free cash flow specifically.
They expect it to be negative for the full year.
Negative free cash flow.
But they did qualify that. They said it wouldn't be negative in the triple-digit millions, so less than 100 million euro negative. They promised more details, including a review of capital spending, with the full Q2 results in July.
Okay, so managing cash carefully, negative FCF expected, but maybe not catastrophic. Seems they feel okay about liquidity for now. Did they touch on the midterm outlook beyond 2025?
Yes, an analyst asked if this 2025 revision impacts their longer-term goals. Management's view, at least right now, is that these issues are primarily short-term.
So they think 2025 is a blip, not a fundamental change.
That seems to be the message. They said they'll update the official midterm guidance after reviewing everything in the coming weeks.
And when do we get that update and the full Q2 numbers?
Still on schedule for July 10th, 2025. That's when we'll see the full H1 results and the updated midterm view.
And they still plan to hold that bigger investor event.
Yep, the Capital Markets Day is still planned for late summer or early fall. That should give a much broader picture, the new business structure post-Bormole, the longer-term outlook, and probably the decision on that molded glass strategic review.
Okay, so that brings us to the end of this deep dive. To recap, a necessary cut to 2025 guidance due to softness in specific areas like cosmetics and oral liquids, hitting organic growth and margins.
Right, but they're banking on a much stronger second half, driven by site repairs, new lines, and especially those GLP-1 solutions.
Financially, the big move was the dividend cut to preserve cash. But management sounds confident about liquidity and staying within debt covenants, despite higher leverage for now.
And we'll get the updated midterm picture on July 10th with more strategic details later in the year.
Exactly. So here's something to chew on, thinking about everything we've just heard. Management was very specific about cosmetics and, maybe more surprisingly, cough syrup packaging impacting results.
Yeah, the cough syrup link was quite direct.
So what does this tell you about the company's vulnerability? Does this recent hit suggest maybe their exposure to things like seasonal health trends or specific pockets of consumer spending was perhaps a bit underestimated in their plans? And what might that mean for their resilience moving forward?
That's a really good question to ponder as you digest all this information.
Definitely something to think about. That's all the time we have for this deep dive. Thanks for joining us.